Hello, everyone, and welcome to today's weekly market insights. Now, as we look across the calendar, Monday we had no high impact data releases to look at on Monday. The main focus for Tuesday was, in fact, the RBA interest rate decision. Now, Reserve Bank of Australia, in their statement, first couple of sentences, did state that they were going to maintain the cash rate target at 10 basis points and the interest rate on exchange settlement balances at 0%. We're going to maintain the target of 10 basis points for the April 2024 government bond, and they are going to continue to purchase government securities at the rate of 4 billion Australian dollars per week until mid 2024. Little bit of a dovish meeting, dovish statement to move forward into Wednesday, which was quite the opposite with the RBNZ, the Reserve Bank of New Zealand. Now, in their statement, they did include the words that the Monetary Policy Committee agreed to increase the official cash rate, the interest rate, to 0.5%, consistent with their assessment at the time of the August statement. Now, they did tell us in August that they were going to raise rates. They were going to raise rates at their last meeting, but they had a nationwide lockdown the day before and were not able to continue with that, but they did keep to their promise that they were going to increase the interest rate at this meeting, which means that they are the first G8 central bank to increase their interest rates and are considerably more hawkish at the moment than some other central banks, namely the RBA, who are on differing monetary policy paths. They said that it is appropriate to continue reducing the level of monetary stimulus so as to maintain low inflation and support maximum sustainable employment. Now, they did also state later on in the statement that headline CPI inflation is expected to increase to over 4% in the near term, which is quite high, which calls for the measures that they are taking at the moment. Now, they did state that inflation is accentuated by higher oil prices, rising transport costs, and the impact of supply shortfalls. That is consistent with all other central banks. Everything that economists are saying for the reasons for high inflation seem to be fairly consistent across the board. Now, as we look across to America, big talk this week was about the debt ceiling that was due to be reached by October the 18th, which is not too far away, less than 2 weeks now at this point. But the Senate did agree yesterday that they were going to increase the debt limit by 480 billion US dollars, which is around 350 billion pounds sterling, which should cover the US until December. Early December. Me personally, I think there's no chance that they allow the Americans to default on debt, but the vote in the Senate was only 50-48 to increase the debt limit, which is kind of insane to me. But we'll have to see how that plays out over the next couple of months. Now, as we look across the charts, we can see this relayed in some choppiness across the S&P, some choppiness across the Dow Jones. Then we did get the news around here that they were going to increase the debt limit, and then we did get a big rally off the back of that. Some positivity for stocks, that would be incredibly negative if the Americans were to default on their debt. We see big positivity in the S&P. We see big positivity in the Dow Jones. But a correlation that does not normally play out is a higher dollar and higher indices. Now, we see this chart of euro dollar. We are in a clear downtrend. A couple of reasons for that. We've also got rising US Treasury yields, which makes the dollar a more attractive proposition for investors, seen as they are able to generate higher yields. We also got the euro with the ECB with their relentless bond purchasing showing no signs of slowing down anytime soon. And then, which then brings us on to oil. If we blow up this chart, we can see the price of oil still continuing to grind higher. We see the prices of gas, energy, with the energy crisis now in the UK and the Eurozone, expecting to reach the US as well. It's not good for households. It's going to be a long, expensive, and probably cold winter for a lot of people if they do not do something about this. Um, Vladimir Putin has come out in support, and he has said that Gazprom will send more gas via Ukraine than it is contracted to this year to help deal with the crisis across Europe. I think some help is needed from other countries, with Russia being such a powerhouse in energy with oil and gas. They can be a lot of help, but that will obviously come at a cost. Um, and we can see here as we look across the gold, the choppy sideways price action, bringing us on to NFP later on today, which is the main focus of the week. Non-farm payrolls causing such rain-bound markets in gold. We see across here in euro dollar the past 2 days, after this sell-off has paused. Somewhat surprisingly, maybe US government bonds, the 10-year yield, government bonds continue to sell off. Yields continue to grind higher. Pre-NFP, maybe they know something that the rest of the market doesn't. Maybe they're predicting higher job figures, which is understandable, seeing as the massively high numbers and massively low numbers created by the pandemic are starting to dissipate. As we're starting to get past it, we're starting to move forward. Businesses are starting to function a little bit more smoothly, and I think now with these figures, we're starting to get a more accurate representation of the labour market in these countries, which the Canadian employment rate as well can make for some good trading opportunities. The Canadian dollar, you normally get some when the Canadian dollar moves, it normally doesn't move too aggressively, it normally grinds higher, which can make for some decent trading opportunities. Both at the same time today, maybe dollar CAD's one to park to the side for these data releases today, but certainly this could generate us some good trading opportunities later, and we will be sure to update with another video later on after the release. So that's all from us for this week here at LAT, and please do join us for another week of weekly market insights next week. Thank you.